Welcome to KonceptCraft. Introducing the Accounting Arena book, your ultimate guide to mastering the fundamentals of accounting. Embrace the world of accounting knowledge at your fingertips. Act now, and get your copy of Accounting Arena ebook. Link is available in the description below. Keep learning. Keep growing. Happy learning. Now let's begin our today's lesson.
Last in, first out LIFO. Last in, first out, LIFO, is a method of inventory management that assumes that the most recent items added to a stockpile are the first ones to be sold or used. This means that the inventory cost of the items sold or used is based on the most recent purchase price, and the remaining inventory reflects the oldest purchase price. LIFO is often used by companies that sell products with a high turnover rate, such as groceries or gasoline. LIFO can help reduce taxes in periods of rising prices, since the higher cost of goods sold reduces the taxable income. However, LIFO can also distort the true value of inventory and make it harder to compare financial statements across different companies that use different inventory methods. Last in, first out, LIFO is an inventory valuation method used by companies to determine the cost of goods sold, COGS, and the value of ending inventory. Unlike the first in, first out, FIFO method, LIFO assumes that the most recently acquired or produced items are the first ones sold. Here's how LIFO works. Purchases. When a company acquires inventory, each unit is assigned a specific cost. The cost assigned to the most recent units purchased or produced is considered first. Cost of goods sold, COGS. When goods are sold, the cost of the units sold is based on the cost of the most recent or latest units available in inventory. This cost is then recognized as a COGS on the income statement. Ending inventory. The value of the remaining inventory is based on the cost of the oldest or earliest units acquired or produced. This cost is reported as the value of the ending inventory on the balance sheet. LIFO is based on the assumption that items in inventory are sold in the reverse order of their acquisition or production. It assumes that the most recently added inventory items are the first ones to be removed or sold. Advantages of LIFO. Tax benefits. In periods of rising prices, LIFO tends to result in higher costs of goods sold and lower net income, which can lead to lower tax liabilities. Cash flow improvement. Since LIFO matches more recent higher costs with revenue, it may result in lower taxable income, which can lead to improved cash flow in the short term. Disadvantages of LIFO. Inventory valuation. LIFO may result in understating the value of ending inventory on the balance sheet during periods of rising prices because the inventory is valued at older, lower costs. Financial reporting challenges. LIFO can lead to complexities in financial reporting due to potential distortions in inventory values and comparisons with companies using other inventory valuation methods. It's worth noting that the use of LIFO is primarily allowed for tax purposes in certain countries like the United States. In these cases, companies that use LIFO for tax purposes often provide supplemental disclosures in their financial statements to show the impact of using a different inventory valuation method, such as FIFO or average cost, for reporting purposes. The choice of inventory valuation method, such as LIFO, FIFO, or average cost, should be carefully considered based on the specific circumstances of the business and the prevailing accounting and tax regulations in the relevant jurisdiction.